Each unit trust invests into underlying assets, such as equities, bonds, or money market investments, and invests locally and/or offshore. Each type of asset performs differently under different economic conditions, has different expected time horizons for achieving returns, and has different risks associated with it. Remember that you will gain exposure to the assets a unit trust owns by buying units in that unit trust. You will not be directly invested into these assets, but you will share in the returns they earn, and you will be exposed to the risks associated with them. Some unit trusts invest in only one kind of asset, while others invest in a combination of asset classes. The latter are known as asset allocation or solution unit trusts. Since different assets carry different types and levels of risk, asset allocation unit trusts spread or diversify these risks across asset classes. This allows the investment manager to balance potential returns with risk and achieve specific investment goals. Investors in these unit trusts hand the asset allocation decisions over to investment managers. Equities are also referred to as shares or stocks in a company. Unit trusts that invest in equities use investors' pooled money to buy a selection of shares that the investment manager believes will perform well over time. The Allan Gray Equity Fund is an example of an equity-only unit trust investing in South African shares listed on the Johannesburg Stock Exchange, or JSE. An equity investment grows if the share prices increase and earns income if the share distributes company profit, known as dividends, to shareholders. Equity investments are regarded as risky investments since share prices may go up or down depending on various economic factors. Equities tend to fluctuate more than other asset classes, especially in the short term. Equities are associated with higher returns than other asset classes, but should be thought of as long-term investments. Investors who need to sell units when the money is needed may be forced to realize a loss if the value of the units at the time is less than what they were bought for. You need to be able to wait out the ups and downs to benefit in the long run, and you need to be comfortable with often dramatic volatility, including periods of underperformance that can sometimes last for many years. Bonds are a type of interest-bearing asset. They are structured loans used by companies, governments, and other entities, and have defined interest rates with payments after specified time periods. Unit trusts that invest in bonds buy a selection of these loans that the investment manager believes will deliver returns in line with the unit trust's objectives. The Allan Gray Bond Fund invests mostly in South African bonds and also other interest-bearing investments, including fixed deposits, money market instruments, and cash. Bond returns come from the interest earned by the underlying loans and from capital growth if the bond prices increase due to increased demand for these assets. Bond investments are associated with lower but more stable returns than equity investments. Bond prices do fluctuate depending on economic conditions, but to a lesser extent than equities. Money market investments are another type of interest-bearing asset and are often thought of as cash or cash-equivalent investments. They are essentially short-term government or corporate loans of less than 1 year that earn interest. The Allan Gray Money Market Fund invests in selected South African money market instruments providing high income and a high degree of capital stability. Although no investments are completely risk-free, money market investments carry a very low risk of losing money and are considered safe. However, money market investments offer much lower returns than most other asset classes. Therefore, they can be used as short-term investments where capital stability is a greater priority than high return. Essentially, hedging is an investment strategy that involves holding an investment such as equities that carries the risk of loss, and then investing into other specially designed financial instruments such as those called derivative contracts or futures to counteract potential losses and increase the likelihood of positive return. Hedging can be thought of as decreasing an equity investment's exposure to the stock market, because the portion of the investment made up of equities that have been hedged typically delivers returns not closely linked to the returns from the general equity market. This portion is called hedged equities, while any equities that have not been hedged against are called net equities. Some of the Allan Gray funds use hedging to varying extents in achieving their investment objectives. While property is generally understood to mean real estate, such as land or housing, in unit trust investments, property may refer to real estate listed on a stock exchange, or to property equity, which are shares that the fund holds in property, holding, or development companies. Many of the Allan Gray funds may invest into property equity, depending on where the investment manager finds value at the time. Raw materials with fixed prices such as gold, steel, or coal are called commodities. In unit trust investments, the term commodities usually refers to direct exposure to a commodity, and the term resources refers to shares in companies that produce them. Some unit trust management companies may also refer to these shares as commodities. The Allan Gray Balanced Fund and the Allan Gray Stable Fund may have direct exposure to commodities depending on where the investment manager finds value at the time. Depending on various factors such as global economic conditions and the exchange rate, offshore assets may at times perform better than local, and vice versa. There are different types of unit trusts that invest into offshore assets, and allocating a portion of your investment to some of these unit trusts allows you to diversify your investment so that you have the potential to earn returns under different conditions. Alternatively, you can invest in an asset allocation unit trust that buys a mix of assets, including offshore assets, as part of the investment manager's strategy. This will mean you do not need to decide when it is appropriate to invest offshore versus locally. There is a wide range of unit trusts available that invest into offshore equities, bonds, money market instruments, and other assets that you can invest in using rands. These are called rand-denominated offshore unit trusts. You can get offshore exposure by including one or more of these unit trusts in your investment. The Allan Gray Orbis Global Equity Feeder Fund, the Allan Gray Orbis Global Fund of Funds, and the Allan Gray Orbis Global Optimal Fund are examples of rand-denominated offshore unit trusts that invest into underlying unit trusts managed by our offshore investment partner Orbis. If you wish to take your money completely offshore instead of investing in rands, you can invest directly into a foreign currency unit trust offered by an offshore-based investment manager. you will need to comply with SARS foreign investment regulation or use money already in an offshore bank account. Orbis Investment Management Limited is our offshore partner and is an example of an offshore investment manager that offers a range of unit trusts in foreign currencies. You can think of asset allocation unit trusts as pre-packaged solutions, which are designed to meet specific objectives by investing in a combination of different underlying assets. When you invest in these unit trusts, you do not need to switch between unit trusts based on market or economic conditions. The investment manager will make all these choices for you. In fact, in order to experience the benefit of the investment manager's expertise, it is important to select an asset allocation unit trust that matches your own objectives and risk profile, and to remain invested for the duration of your investment, unless your needs or risk profile changes. The Allan Gray Balanced Fund and the Allan Gray Stable Fund are examples of asset allocation funds that invest in a mix of equities, bonds, property, commodities, and cash, and allocate between local and offshore assets depending on where the manager finds value.